Hello, my name is Eugene O'Callaghan. I am the Director of the Ireland Strategic Investment Fund and I'm a faculty member at the Sovereign Investment Academy. I think sovereign development funds really are funds with a mandate to invest with some development objective in their national country or in their local country. In our case, we have an economic impact objective. Our objective is to invest commercially like any sovereign wealth fund would do, but every investment must support economic activity and employment in Ireland, which is the economic impact objective. So investing with the double bottom line is where both commercial return and, in our case, economic impact must be achieved on every single investment. It's tough to achieve both of these objectives on investments, but we've developed a methodology and an approach which we hope achieves that. Commercial investment we look at really in the context of the phrase risk-adjusted expected return. We would expect every investment should have an expected return which is commensurate or equivalent or related to the risk that's involved in the transaction. So if we had a low risk transaction, we would be happy with a low return. If we have a high risk transaction, we'd need a high return. On the economic impact side, we look at in particular additionality. Will our investment add or support incremental or new economic activity in Ireland? And in doing that, we look to see that there's new production, new output, additional activity, and we also look to make sure that we are not displacing or crowding out investors who are already in the market, and we also need to make sure that we're not giving any soft money or free money away. It's all commercial investment every time, even though the economic objectives are also there. We like to have investors alongside us or co-investment on every transaction that we enter into. This is for two reasons really. One is a co-investor is a validator or a validation of the commerciality of our investment. You know, if there was any sense that we're a public fund and we were giving soft money or free money into transactions, co-investors helps allay any of those concerns. And secondly, if we have co-investors alongside us, that means that we need to use less public or of our fund's money in order to achieve the same economic impact. Obviously, if we have the more co-investor money we have, the less of our money we need to put into the transaction. In terms of how we obtain or generate co-investment, we will always be prompting companies, project sponsors and so on, who are the other investors who might be interested in investing alongside us. We have relationships with international investors, both sovereign funds and private investors, and ultimately co-investors on every transaction are different, and so we adopt a case-by-case approach. But you know, on average, so far we've had, for every euro of our investment in a transactions, we've had 1.9 euros of co-investor money, both international and Irish co-investors. Education is obviously important always. You know, sovereign wealth funds in general clearly face different issues and problems than conventional investors. There are specific sort of agendas, there are specific stakeholders that are specific to sovereign funds that don't necessarily apply in the commercial investment marketplace. It's obviously public money. Politicians are involved, government departments. So in a sense, all of those issues need to be considered in light of regular investment, alongside regular investment considerations. In our case, as a sovereign development fund, education becomes absolutely critical because there are very few sovereign development funds around. Any of them that are there are very recent. There's no history, there's no expertise being developed, and so the whole area of research, education, sort of sharing of knowledge and information in relation to how sovereign development funds should work is absolutely critical in my view.